What is up, everyone? You know who it is, the cash flow cowboy, Justin Warziniak. I want to talk to you guys, especially my newbie investors, about how to establish that investment criteria. First things first, the asset class. What do I mean by this? It's pretty much divided into 4 classes in the real estate world. We got A, B, C, and D. This is very similar to when you were back in school and you got a grade on your math test. A is the best. These are the ones with the best amenities, the luxury premier apartment buildings. They're usually in nice locations, you know, like a downtown or something like that. The B class assets are one step down. Hey, you didn't quite get all of the questions right on the math test, but you got a good amount of them. So they'll have some amenities. The location will probably be, you know, not quite in the heart of downtown, maybe on the outskirts or a suburbia type area. But these are also great areas to be. If you can get a C-class asset in a B location, then you're set up for success. The C market or C-class asset is probably not gonna have too many amenities, but it is going to have a lot more cash flow. So as you go down in class, so from A, B to C, you're supposed to get a higher return on your money because the assets are a little less stabilized. They're not in great locations. So, you know, for that work, you want to make sure you get some more money. And lastly is our D class assets. And I highly recommend you stay away from the D class. This is, if you want to manage in D class, you're going to be a slumlord. They're going to be tough to get rents from. The tenants are not great, and these are just rundown areas, no amenities, even the asset itself. The next criteria is size, and you know it, size always matters. So what do I mean here? This is pretty much unit count. So you can go to 2 to 4 units, and that's, you know, personal financing, smaller investments, probably a little less risky. Because, you know, your mistakes are smaller. Or you can go big. You can do the 5+ commercial apartment buildings, and those are going to be, you know, better economies of scale. Criteria number 3 is location. Location. When you talk about real estate, you got to make sure that you're in the right spot. And this is, you know, from a high level, you want to make sure you're in the right market. You want to see a market with growth, income growth, jobs. But then you also, on a micro level, want to make sure that you're on the right street, you're in the right area of town that is going to see growth. For location, just know it's market, and then it's also local, and then this local kind of street by street. Make sure you reach out to brokers so you can understand that. Drive the market is also a great way to figure out what areas are nicer and what are, you know, probably not an area you want to invest in. Numero 4 on the investment criteria is stabilized versus a value add property. What do I mean by that? If it's stabilized, it means the occupancy is high. And then it also means that you're probably not gonna have to go in and renovate the units at all. And if you do, it's probably some light renovation. So pretty much it's just a stable cash flow from this asset. You know, it's at market rents around there, and so it's less risk. However, you know, with less risk, you're probably going to get less return on it. If you want to go for the higher returns, higher risk, that's going to be the value add, and that's going to be, you know, renovations or just, you know, repositioning the asset. You know, new management could also be a significant value add. But it's gonna be riskier, but you can go ahead and make some more money. And forced appreciation is a term that's used a lot in the value add game. So number 5 is the price range investment criteria. And this is pretty much, you just need to know how much you can afford. A lot of times your bank lender will tell you up to a certain amount you can invest. On the larger properties though, you usually have investors, so it's how much you can raise. So that's kind of the difference there. So those are the 5 investment criteria that you should focus on. And now I'm going to touch on why it's important. The main reason is credibility. So you need to be credible with brokers, with lenders, with other investors, property managers. And what shows credibility better than knowing exactly what you want in a property? So that's what they're sending you. The broker's only sending you properties that meet your criteria. And it really makes you look better when you can tell someone in detail what you're looking for. It also helps you stay on track. A lot of us in the investment world, we chase the shiny objects. So this is a good way to know exactly what you're looking for, and it'll stop you from going all over the place. And by doing so, you can actually become an expert in your little niche, we'll call it, your little investment criteria space. Now, I know I went through these 5 criteria quickly. In the next videos, we're actually gonna dive in deeper to the class, the size, the market, and how to find your ideal investment criteria down to the nitty-gritty details. So there you have it. That wraps it up. If you enjoyed the video, like, subscribe, and share. And until next time, Cowboy out.